This is the number most operators don't see until it's too late. Negative $5.8 million. I'm Justin Ferguson. Last week, 3 separate investor groups showed me their underwriting on Virginia value-add deals. All 3 models look profitable, double-digit IRR, strong cash-from-cash return, clean exits. All 3 models were wrong. There's one assumption buried in your spreadsheet right now that's costing you millions, and I can prove it with the same property, the same market, and the same hold period. In the next 10 minutes, I'll show you exactly what changed, where it's hiding in your model, and 3 numbers you need to fix before you sign your next LOI. Let me paint a picture of how we got here. In 2021, underwriting was easy. You could assume 4% annual rent growth, plug in 5% vacancy across the board, and plan your exit at a cap rate 50 basis points lower than where you bought it. Everyone was making money because the market was rising so fast that even conservative deals look like home runs. But here's what's actually happened in Virginia. Richmond vacancy climbed from 5.2% in 2021 to 8.2% today. Rent growth decelerated from over 10% at the peak in early 2022 to less than 1% in the past 12 months. Meanwhile, cap rates expanded. Exit cap rates that were underwritten at 5.5 to 6% in 21 are now trading at 6.3% or higher. That means if you're still underwriting to cap rate compression, you're literally building models where your property can't sell at the price you projected. The mistake I see operators making is they're still using spreadsheets built for yesterday's market to justify today's pricing. They're convincing themselves that a temporary market correction will revert to 2021 dynamics. It won't. This isn't a temporary correction, it's a fundamental reset. And the operators who understand this are the ones positioning themselves for the next cycle. Let me show you exactly what I mean with real market data from Richmond, Virginia's largest multifamily market. Chart 1, rent growth deceleration. At the peak in early 2022, Richmond was seeing 10.2% year-over-year rent growth. Today, we're at 0.9%. This isn't just a Richmond story, it's playing out across the Hampton Roads, Northern Virginia, and every other major Virginia market. The days of 4% annual rent bumps are over. Chart 2, vacancy climbing. Richmond's vacancy rate has increased from 5.2% in 2021 to 8.2% today. That's a 58% increase in vacant units. On a 100-unit property, that's a difference between 5 vacant units and over 8. On a 150-unit deal, you're looking at 12 vacant units instead of 8. That's $6,000 to $9,000 per month in lost revenue that wasn't in your original model. In chart 3, the cap rate expansion crisis. This is the chart that should keep every operator awake at night. Market cap rates in Richmond have expanded from around 5% in 2021 to 6.3% today. For higher end properties, we're seeing cap rates at 6.1%. Let's say you've got a $10 million acquisition that cash flows $600,000 at year 1. If you underwrote a 5.5% exit cap, you'd expect an exit value of nearly $11 million. But at today's 6.3% cap rates, that same NOI produces an exit value of $9.5 million. That's a $1.5 million reduction in exit value. On a deal with 75% leverage, that entire loss comes out of your equity. But here's the real problem. With less than 1% rent growth and 8% vacancy, growing that NOI enough to hit your original exit value isn't happening. You're trapped in a deal that can't refinance and can't sell your underwritten price. This is why I completely rebuilt my underwriting model. The old assumptions don't just produce lower returns, they produce deals that literally cannot be executed in today's environment. So let's break down the 3 fundamental changes I've made to my underwriting model, starting with rent growth. Shift number 1, rent growth assumptions. The old model assumption, 3 to 4% annual rent growth compounded over the hold period. New model assumption, 1 to 2% annual rent growth stress tested down to 0. Here's what this looks like in practice. Typically a Class B property in Richmond, Virginia, averaging $1,500 per unit rent. Under the old model, you'd project rent hitting $1,690 by year 3. That's $190 per unit in growth. Under my new model, those same rents might reach $1,545 by year 3, just $45 per unit in growth. On a 100-unit property, that's $228,000 less in annual revenue than you originally projected. But here's the critical part. I don't just use the lower assumptions, I stress test every deal at 0 rent growth. If your deal doesn't work with flat rents, it's not a real deal. Because in markets like Richmond, we've seen periods where effective rents actually decline when you factor in concessions and vacancy. Speaking of concessions, this is something where most operators completely miss their models. Today's market is seeing meaningful concession levels that reduce effective rents below asking rents. That means even when you raise asking rents, your effective rents are getting slower or growing slower or not at all. Shift number 2, vacancy and collections. The second major shift is how I model vacancy and collections. Old model, 5% physical vacancy, maybe 2% for collections loss. New model, 8 to 9% physical vacancy plus 3 to 4% collections and concessions. Let me show you what this means on an actual deal. I recently analyzed a 120-unit Class B property in Chesterfield County. Under old assumptions, you'd model 6 vacant units and collect rent on 114 units. Under my new model, you're looking at 10 to 11 vacant units plus another 3 to 4 units worth of collection losses. So you're effectively collecting rent on 106 units instead of 114. At $1,400 average rent, it's $11,200 less in monthly revenue, over $134,000 per year. Over a 3-year hold, that's over $400,000 in lost cash flow that wasn't in your original underwriting. This isn't theoretical. Richmond stabilized vacancy is running 8.2% today, and that's for the overall market. For value add deals where you're pushing rents and dealing with renovation downtime, you need to model even higher vacancy. I'm typically using 10 to 12% during heavy renovation phases. And collections have gotten tougher. Post-pandemic, we're seeing more residents who know how to game the eviction system. It's taking longer to turn non-paying units, and legal costs have increased. Shift number 3, exit cap rate and stress testing. The third shift, and this is the big one, is how I model exit assumptions. Old model, exit cap rates 25 to 50 basis points lower than entry, buy at 6%, sell at 5.5%. New model, exit cap rates 50 to 75% higher than entry. Buy at 6.5%, exit at 7 to 7.25%. Let me show you the math on why this matters. Take a stabilized NOI of $1.2 million on a value add deal. Under the old model, $1.2 million NOI at 5.5% exit cap equals $21.8 million exit value. Under my new model, $1.2 million NOI at 7% exit cap equals $17.1 million exit value. The $4.7 million difference in exit value on the same exact deal with the same exact NOI. Here's why this is critical. Most value add deals are using 70 to 80% leverage. If your exit value drops by $4.7 million, the entire loss comes out of your equity. On a $15 million acquisition with 75% leverage, you put in $3.75 million of equity. A $4.7 million reduction in exit value means you're losing more than your entire initial investment. This is why I stress test every deal at exit cap 100 to 150 basis points higher than entry. Because if cap rates move against you, and they have been, I need to know my downside before I put capital at risk. The market is always proving this out. Recent sales in Richmond are trading at cap rates 50 to 100 basis points higher than comparable deals from 2022. The operators who are still underwriting the cap rate compression are the ones getting hurt. The smart money is positioning for a flat to no rising cost cap rate environment and building in protection against that scenario. Let's walk through a real example of how these changes impact actual deals. Let's use a 150 unit Class B property in Henrico County that I analyzed for a client group. Built in 85, average unit 850 square feet, in place rents around $1,300 per unit. Here's how this deal would have been underwritten in 2021. Purchase price, $16.5 million. Entry cap rate, 6.2%. Year 1 NOI, just over $1 million. Rent growth, 3.5% annually. Vacancy, 5%. Exit cap rate, 5.7%. Hold period, 3 years. Under those assumptions, the deal shows a 14.2% IRR and a 1.67 equity multiple. Looks great, right? Now here's that same deal under my 2025 model. Same purchase price, $16.5 million. Entry cap rate, 6.2%, market pricing. Year 1 NOI, $950,000, reflecting higher vacancy and collection loss. Rent growth, 1% annually. Vacancy, 8%. Exit cap rate, 6.9%. Hold period, 3 years. Under realistic 2025 assumption, this deal produces a 6.8% IRR and a 1.19 equity multiple. Same property, same renovation plan, same market, but the difference is returns is staggering. The 2021 model shows a deal that looks like a winner. The 2025 model shows a deal that barely beats inflation. And here's the scary part. The 2021 model shows positive cash on cash returns from year 2 onward. The 2025 model shows you'll be feeding this deal cash for the entire hold period. Even worse, under the 2025 model, this deal struggles to refinance at maturity. NOI of approximately $1 million at year 3 and prevailing cap rates at 7%, this property would need to trade at an unrealistic sub 6% cap rate just to break even on a refi. In today's market, that's not happening. This is why updated underwriting isn't just about lower returns, it's about avoiding deals that can legitimately bankrupt you. Here's the bottom line. Investors who cling to 2021 underwriting models are going to overpay for deals that underperform. They'll find themselves trapped in properties that can't refinance and can't sell at their projected exit values. But operators who embrace conservative 2025 underwriting are finding opportunities that others are missing. Because when everyone else is chasing deals that pencil at 5.5% exit caps, You're finding value in deals that work at 7% exit caps. When everyone else needs 4% rent growth to hit their returns, you're buying deals that work with flat to minimum rent growth. This creates two powerful advantages. First, you're buying better deals at better prices because you're not competing with over-leveraged operators who are using aggressive assumptions. Second, you're positioning for compounding returns when the market does recover. If you underwrite conservatively and the market performs better than expected, that upside flows directly into your returns. I've been through two major market cycles in my career. In 2008, I've watched operators lose everything because they're underwriting two assumptions that made sense in 2005, but were completely detached from reality. The operators who survived and thrived were the ones who adapted their underwriting to new market reality. They bought fewer deals, but the deals they bought were resilient. We're in a similar moment right now. The market has fundamentally shifted, but most operators are still using old playbooks. That creates opportunity for those who are willing to update their approach. My 2025 underwriting model isn't just about being conservative, it's about being realistic. It's about underwriting deals that actually work in today's environment, not deals that worked 3 years ago. The groups I work with who have adopted this model are still finding deals. They're getting better pricing, better terms, and building portfolios that will thrive the next market cycle. Choice is yours. You can keep using outdated models and wonder why your deals aren't performing, or you can adapt to new reality and position yourself for success in 2025 and beyond. If you're analyzing 20 to 150 unit value add deals in Virginia, don't rely on outdated spreadsheets that could cost you millions. Book a call with me in the description. I'll walk you through my 2025 underwriting model, show you how to stress test your deals, and share exit strategies that work today. The operators who adopt first are the ones who win. The market has changed. Your underwriting needs to change too.